On today's episode, I'm going to take a look at 3 stocks that you should add to your watch list for long-term investments. I just ran my screener and I found them, and my screener is looking for the following. It's looking for strong historical compound annual growth rate. That means, does it have strong revenue growth in the past? I'm also looking for strong balance sheet. Does it have a strong shareholder equity? Does it have strong current ratios? And does it have cash flow from operations? Is it making money from its everyday business? I'm also, then after that, I take a look at the company and look at their future growth. What are analysts expecting the growth? So they're also expected to grow at strong levels. And all these 3 companies are going to hit different markets. The first one we're going to take a look at is hitting the gaming market. The second one we're going to take a look at is helping a lot of e-commerce and with the logistics of them, and it's growing at crazy levels. And the third one is in the video streaming services, and it is probably a sleeper right now. So this is the part where I normally spend about 45 seconds to a minute explaining why you should like the video, check out my socials and Patreon. But for the next few days, I want to use it to try to make a difference. Right now, there are tons of kids asking Santa for happiness. This year has been pretty rough for many people, and usually kids don't understand why. And if you're watching this video, it probably means you are blessed like me to continue to put money to work in the market. And I just want to say there are easy ways to give back to the community. One method my wife found is USPS Santa Operation, where kids write to Santa and you can read the letter and adopt the child and send them a gift. I'm sure there are other methods out there, but I just want to use this platform for this. Now, I hope you guys don't mind that short off topic, and let's get back to the episode. So for each stock, we're going to take a quick look at their charts. We're going to take a look at year-to-date performance, at their financial numbers, and their future growth. So the first company we are going to take a look at is Zynga. This is a game developer company. They focus mainly on mobile games, and we'll take a look at that in a second. But right now, their ticker is ZNGA. That's Z as in zebra. Right now, it's sitting at $8.69. Year-to-date, the stock has returned 41% to investors. Congratulations to anybody holding long. But since its peak, it's actually down about 17%. So it's definitely seen a nice pullback. And we can see since I want to say since May, it's been pretty quiet. It's been pretty volatile in the short term of things. But if we take a look in the long term of things, it's been pretty quiet and hasn't moved much. Right now, it has a market cap of $9.38 billion. And like I mentioned, I've mentioned this in yesterday's video on the stocks that I purchased. I feel like right now eyes are focused in different sectors. So now we're getting kind of quietness in like the gaming sectors and like the e-commerce sectors. So a lot more people are focused right now on EV stocks, on marijuana stocks, on clean energy, and for their own reasons, right? I don't believe those are bad investments, but I like to keep eyes on places where not everybody is looking at right now. So if we take a look at charts for Zynga, I'm looking for 2 things. First, is it overextended from its moving averages? And like I mentioned, I am a long-term investor, so technicals don't play too big of a role when I purchase a company, but I do want to see certain aspects, and they hold a small selection of what I look at. So first, they are not overextended. We can see the stock price right now is sitting next to all 3 of its moving averages. We can see that's probably a great entry point for many. The second thing is it's sitting at strong volume areas. Like I mentioned, since probably June or May, this stock price hasn't moved up. So we're seeing a lot of volume within these areas. That's another great thing for me to see. So now let's take a look at Zynga.com and see what they do. So they're pretty much a mobile gaming company. We can see all the type of games. They have Tiny Royale, Merge Dragons, they have CSR Racing, they have Harry Potter games, they have RPG puzzles, Empires and Puzzles, so Words with Friends, poker. So we can see they are a gaming company that mainly focuses on mobile games. And I do believe mobile games is the best market to be in the gaming industry. So I can see the future growth in it. So if we take a look at Zynga, first I want to see their future growth. They're expected to grow 15.3% on average annually for the next 3 to 5 years. That's a strong compound annual growth rate for the upcoming years. Another thing, they are positive in cash flow from operations, so they're making money from their everyday activities. Now, if we take a look at their financial statement, they have about $755 million in cash, and they have about $589 million in debt. So they have more cash than debt. Obviously, I would have wished for a stronger balance sheet, but it is a lot higher than their debt. And like we saw, they do have positive in cash flow from operations. So that means they have money to continue to run their everyday business. Zynga's most recent earnings, they saw huge number growth. Their revenue was up 46% compared to the same time last year. Their bookings were up 59% compared to the same time last year. Their mobile daily active users rose 53% to 31 million, and their mobile monthly active users rose 23% to 83 million. Those are huge number growth. The stock price was overextended. It probably was a few when this quarter announced, because it dropped about 7.5%. But remember, earlier through this COVID section, a lot of people were focusing on the gaming stocks that might have overextended them a bit. Then they cooled down a bit, and now are just kind of sitting flat for the moment. If we take a look at some big whales are also purchasing. For quarter 3 of 2020, they increased the total amount of shares that were holding by big whales. In quarter 2 of 2020, about 750 million shares were owned by big whales. Now 810 million, so an increase of 60 million shares were added to big whales in the past quarter. That's insane. We're seeing that that big whales are very bullish in the company right now. The second company is ZTO Express. But before we go any further, guys, make sure to check out my Patreon, where if you want to learn to become a better investor, I post a lot of educational content in there for great prices, great value. Make sure to check that out. So the second company is going to be ZTO Express. This is ticker ZTO, and this is a Chinese company right now. Their headquarters is in Shanghai, China. Year to date right now, they are up 18%, but compared to the all-time highs, they are down about 27%. Current market cap is $23.84 billion. So ZTO Express is the leading express shipping operations in China. And if we take a look at their most recent report, they show they're the number one. They own about 20.8% of the market share right now. They cover about 99% of the country with high-level cities. They have over 10,000 line haul vehicles. They have about 3,400 routes, about 91 sorting hubs, about 300 automation lines. They are the number one in last mile post, and they're also number one in the amount of parcels they deliver per year. So they're a big location right now. Here, if we take a look at this chart, let me zoom in for you guys. Alibaba in 2018 led a 1.38 billion strategic equity investment. So they do own some portion in the company right now. And that's pretty good, because we know Alibaba is one of the biggest e-commerce markets in China. So if they're being backed up by Alibaba, I believe that's a great move, and a great move for Alibaba as well. They do pretty much the full thing. The first mile pickup is they go to the customers who are sending the packages. They pick up those packages, send them to outlets to then go through the sorting hubs, then go through line haul transportation, then go through the sorting hubs of the delivery place. And they also do the last mile delivery, which is the delivery from now outside. Once it goes to their final sorting hubs, they then send it to the recipient. So they pretty much do the whole process from beginning to end in this travel business. So one of the biggest things that they're saying is super bullish for ZTO and pretty much any delivery system right now is the growth of e-commerce. So e-commerce in China in 2019 had a penetration rate of 20.7. By 2024, it's going to have a penetration rate of about 32.4. It probably might be even a bit higher now due to COVID situation, but that is strong compound annual growth rate of 17.5%. The amount of online retail sales of physical goods is also increasing over time. So obviously, if Alibaba is going to be doing good, ZTO is also going to be doing good. And now let's take a quick look at their charts. First thing, are we overextended? We can see no, we're around the moving averages at the moment. The only bad thing I can say right now, it is definitely in the downtrend. A lot of Chinese companies have been in the downtrend right now. We have Huya, we have Doji. So that's happening right now. It probably could be with the overall tensions coming here with in the America and the United States. But again, if one invests in Chinese companies, you understand those risks. One of my ways to manage those risks is to understand how much am I going to go in the Chinese stocks? How much is international companies going to hold a percentage in my portfolio? I would never do 100% right now. For me, at most 20% of my portfolio are international companies. So that's how I do it. I want to see how do you guys manage types of risk with internationals. Another thing, are we sitting in strong volumes? We can see CTO is having strong volumes in multiple areas. So that's another great thing. Now, if we take a look at their future growth, CTO is expected to grow its revenues 21.3% on average for the next 3 to 5 years. Hyper growth. It is profitable in earnings and it is positive in cash flow from operations. Great news. And we can see historically it has been positive in earnings and cash flow from operations. If we take a look at their long-term assets, they are also looking good. They have about 21.2 Chinese yuans in $1 billion in yuans and 2.1 billion in debt. So they have almost 10 times more cash and short-term investments than debt. We saw they were profitable. We saw they had positive cash flow from operations. So that's a-okay with me. Like we saw earlier before, Alibaba did purchase into the company into some form of investment. They own about 7.5% of this business. Then the major big players are founders. The founder owns 25% of the business. Then we have some big members. The VP of operations owns 7.78%, and another VP of infrastructure management owns about 6%. So insiders, if we count Alibaba as an insider, own about 45% of the business. That is actually pretty darn impressive. If we take a look at CTO, right now it's been pretty flat compared to quarter two. In quarter three, they have about 220 million shares are owned by big whales. Last quarter, there were 221 million. So it decreased by about 1 million shares. Not a big portion, less than 0.5% decrease. So again, they're pretty flat right now. Again, not many eyes are looking into this market, so it might be another one to add to the watch list. The third one we're going to take a look at is Discovery Communications. And if you guys haven't done so, make sure to check out my second channel, Jose Najarro Entrepreneur. You should see a link down below where I talk about ways to make money outside the stock market. So here, this is ticker DISCA. Right now, it's sitting at $28.93. Year to date right now, it is down about 10%. So it's definitely pulled back a nice amount, and from its all-time highs of the year, it is down probably closer to 12%. Yep, right now it has a market of $13.15 billion. And Discovery, you guys might know them as Discovery Channel. And what is there that made me look at this company? We're going to talk about that in a bit. But first, let's take a look at their charts. So we can see the first thing is they are overextended. Some great news just came out for Discovery Channel, and it has definitely pushed the stock price up. So it is a bit overextended. Right now, I'm not 100% sure which I'm going to buy, if any, but these are definitely entering my watch list as I continue to do more research on them. But Discovery Channel, I do believe if I were to enter right now, due to it being overextended, I might just open up with a small opening position. So we can see it is overextended from its moving averages, and unfortunately, based on the portion where I'm looking at the chart, most of its volume, it's obviously down here where it was pretty flatline for the past few months. Since since March, it hasn't moved much. And now compared to March, since October 29th, it's taken a big leap up. So congratulations to anybody that picked up in the bottom and was patient, right? This is crazy. This is such a thing. Maybe you would have bought here, you sold here because you weren't patient enough, but look at that now. It's up probably about 30%, so strong growth there. So if we take a look at Discovery, why am I kind of excited on this company right now? So Discovery Channel, for those that don't know, they own a nice amount of different channels. They own HGTV, which is probably almost something everybody watches or knows somebody that everybody watches. Food Network, TLC, Investigation Discovery, the Travel Channel, Motor Trend, Animal Planet, Science Channel, and they also own Oprah Winfrey's network in the United States. And in Latin America, they own Discovery Kids and Eurosports. I'm pretty sure some of you guys watch that nonsense TV like I do, 90 Day Fiancé on some random occasions. The Home Builders, the Buying, Inside, Say Yes to the Dress, right? There's a lot of nonsense TV that a lot of people are watching. And now they are releasing a streaming service to launch January 4th with originals and 55,000 plus library shows. This to me, if I might be honest, I thought there were so many streaming platforms right now. Maybe I might be biased because of the Animal Planet and because of Science Channel and because of HGTV and TLC. But I feel like a lot of people just get cable for these reasons, for just these channels. So right now, to see them being in a streaming service, I do believe that's gonna draw a nice amount of people coming into their network. Right now, they're going to have a $5 a month with ads, or you can pay $7 a month without ads. And they're set to launch in more than 25 countries in the upcoming year. And they're going to do global rollouts via distribution partners in United Kingdom, in Ireland, in India, in Nordics, in Italy, and the Netherlands, obviously here in the United States as well. So we can see strong growth. And this is the major news that is driving this stock price up. So right now, if we take a look at future growth for Discovery, they're expected to grow 4.0% annually for the next 3 to 5 years. So we can see their growth rate is not as strong, but I do believe it might be underestimating this type of streaming market. So if one is bullish in the streaming market, I do believe this annual revenue growth can be a lot stronger. If we take a look at cash flow from operations, they have been positive in cash flow from operations. They've been positive on earnings. They're making plenty of money. And with this plenty of cash flow from operations, it's not like they're going to be creating, it seems, too many new originals since they have such a strong catalog, unlike Disney Plus, right, where they have to be creating a lot of new originals back and forth because to bring people to their Disney Plus. I think Discovery A is doing smart with the way they're moving. If we take a look at their financial statement, they have about $2.2 billion in cash and short-term investments and about $14.5 billion in debt. Very weak balance sheet in my opinion, but remember, they are profitable. They have plenty of cash flow from operations. So for me, it is okay for them to have somewhat of a weak balance sheet. If we take a look at big whales have been adding a small portion. In quarter two, 197 million shares were owned by big whales. Now 199 million are owned by big whales, so increased by 2 million. So these are the 3 stocks I wanted to show you guys today. I hope you guys enjoy it. Make sure to subscribe, make sure to like the channel. Take care, guys. Have a good night and see you next time.